Welcome to the Deep Dive. Today we are taking a closer look at AutoZone's latest numbers, their third quarter for fiscal 2025.
Yeah, we've sifted through the earnings call and, the overall takeaway, it's looking like, well, pretty solid sales momentum.
Yeah.
Especially in commercial. But there are definitely some profit pressures they're navigating, mostly from their big investments.
Okay, so strong top line. Seems like their strategy is working there, but yeah, feeling that pinch on the bottom line from the spending and maybe some other stuff.
Exactly. Let's just lay out the key numbers first, set the scene.
Good idea.
So Q3 total sales, $4.5 billion. That's up 5.4% from last year.
Okay, 5.4%. And the same store sales.
Yeah.
Because that tells you about the core health, right?
Right. Domestic comps up a solid 5%.
5%, okay.
And if you break that down, the DIY side, do-it-yourself customers, that was up 3%.
Still positive.
Still positive, yeah. But the real standout, domestic commercial, the pro mechanics, that jumped 10.7%.
Wow, 10.7. That's significant.
It really is. And internationally, growth looked great in constant currency, up 8.1%.
There's always a but with currency sometimes.
Yeah, the strong U.S. dollar hit them hard.
Right.
Especially the Mexican peso. It weakened quite a bit. So when you look at the unadjusted number, international comp was actually down 9.2%. Big swing.
Oof. Okay, so that currency impact plus those investment costs you mentioned, I guess that flows down the income statement?
Definitely. Total operating profit, EBIT, that was down 3.8%.
Okay.
And earnings per share, EPS, also down 3.6% year over year, came in at $35.36 for the quarter.
So you really see that disconnect. Sales are growing nicely, but these other factors are stopping it from hitting the bottom line quite as hard.
Precisely.
Right. Well, let's dig into those sales drivers then, because that 10.7% commercial growth, that feels like the main story here.
I think it is. I mean, management made a point of saying this is their first double-digit commercial growth quarter since Q2 of fiscal 23.
Okay, so it's been a little while.
Yeah. And they put it down to a few things. Better execution, just having the right parts more often and getting them delivered faster. Speed matters to those pro customers.
Makes sense. And was that growth consistent? Or just like one good month?
No, they said it was consistent across the quarter, which is encouraging. And they had a pretty big milestone, too, past $5 billion in commercial sales over the last 4 quarters combined. First time ever.
$5 billion. That's a huge business within the business now.
Absolutely. It's now, 32% of their domestic auto part sales and 28% of total company sales. It's a big piece.
And getting bigger.
Seems like it. Average weekly sales per commercial program were up 8%, about $17,700. And they specifically called out the mega hubs.
Ah, yes, the mega hubs. Heard a lot about those.
Yeah, they stock way more parts, like over 100,000 SKUs. Apparently, they're ramping up sales even faster than the regular stores, so that strategy seems to be working.
Okay, let's switch over to the DIY side. That 3% comp you said. Still, that's not bad either.
No, not at all. In fact, it's the best DIY performance they've had since Q2 of fiscal 22.
Yeah.
So an improvement there, too.
What drove that?
Well, they mentioned a few things influencing the timing. Tax refunds hitting people's accounts, weather patterns, the Easter holiday shift, the usual factors.
Right.
Growth was actually strongest early on, like 6.7% in the first 4 weeks. Then it eased off a bit, 5.1%, then 3.1% later.
But the key thing, traffic.
Yeah, customer traffic was up about 1.4%. That's a really positive sign compared to recent quarters where it was declining.
So more people coming in, not just spending more per trip, although I assume spending per trip is also up.
It was, yeah. Average ticket size and like-for-like price inflation added about 1% to that growth.
Okay. And any regional differences?
Interestingly, yes. They called out the Northeast and the Rust Belt, said DIY was stronger there than it's been for a while. They think a colder winter followed by a nice spring pulled some repair demand forward.
Makes sense. But what about commercial in those same areas?
That's the interesting part. Commercial growth in those same regions was actually slower than the national average.
Huh. Why is that?
They think there's a lag. The cold weather stresses parts, but it might take until later in the summer for those parts to actually fail and need a professional fix. So they expect commercial to pick up there later.
Ah, okay. That classic lag effect between DIY fixes and pro repairs.
Yeah.
Got it.
Exactly.
No, international again. That 8.1% constant currency growth is solid. But that currency, that sounds like a major headache.
It really was a big one this quarter. That Mexican peso weakening almost 20% against the dollar, that alone took about $89 million off the top line sales number.
$89 million, just from FX.
Just from FX. And it hit profits too. knocked about $27 million off EBIT and dragged EPS down by $1.10 down.
Wow. So if you ignore the currency swings.
If you back out the FX, yeah, that reported EPS decrease of 3.6%. It would have only been a 0.6% decrease.
That totally reframes things, puts the underlying operational performance in a much better light.
It really does. And despite those headwinds, they're still pushing ahead internationally, opening more stores, especially in Mexico and Brazil.
International is becoming a bigger part of the footprint then.
Yep, about 13% of their total stores now are outside the U.S.
Okay, let's shift down the P&L. Profitability, margins, expenses. What happened there?
Right, so gross margin came in at 52.7%. That was down 77 basis points compared to last year, so down about 0.75%.
77 basis points. What caused the drop?
A few things. There was an unfavorable comparison related to LIFO inventory accounting. That was 21 basis points right there.
Great.
Then you had the higher mix of commercial sales. Those tend to have slightly lower gross margins than DIY.
Right, the mix shift.
Yeah. Plus some higher domestic inventory loss and costs from ramping up those new U.S. distribution centers they just opened.
So quite a few headwinds on gross margin.
There were, but they did say these offset what was actually decent improvement in the underlying merchandise margins themselves. So the cost of the goods was managed okay.
What about that LIFO thing? You said it was an unfavorable comparison.
Yeah, basically how the costs flowed through compared to last year. Interestingly, they actually had a $16 million LIFO credit this quarter.
A credit, how does that work?
Mostly lower freight costs coming through compared to the older, higher costs embedded in the inventory sold. They still have about $3 million in older LIFO charges left to reverse out, potentially.
They're looking ahead. Q4.
For Q4, they're not expecting any LIFO credits similar to last year. And they even said if new tariffs come in and really push up inventory costs, they might actually see a LIFO expense.
Tariffs. Did they have much impact this quarter?
Minimal impact in Q3, they said. And for Q4, they sounded pretty confident they can manage it.
Ow.
Through, getting vendors to absorb some costs, shifting sourcing around, maybe some strategic price adjustments. They basically expect to keep their overall margin profile intact. And they think the whole industry will be pretty rational about pricing if tariffs do hit.
Okay, makes sense. What about operating expenses? SG&A.
SG&A was up 8.9%, so it grew faster than sales, which means it deleveraged by 108 basis points.
Why the increase?
About half of that deleverage, they said, was from higher self-insurance costs.
Self-insurance.
Yeah, more delivery trucks on the road for commercial, plus settling some older claims from a couple of years back. Overall, SG&A per store was up 5.1%.
And management's take on this higher spending.
They frame it all, the SG&A bumps, the capital spending, as very intentional investments. They're spending now to drive faster growth and grab market share down the road.
Investing in customer experience, speed, efficiency, that sort of thing.
Exactly, all aimed at future gains.
Okay. What about interest and taxes?
Interest expense ticked up 6.6% to $111 million, mainly just higher borrowing rates, even though their total debt was actually slightly down from last year, around $8.9 billion now versus $9 billion then.
So rates are biting there. And taxes?
Tax rate was 19.4%. That's up from 18.1% last year, mostly because they got less of a benefit from stock option exercises this year.
Got it. And for Q4, they expect?
They told investors to model around 23.2% for Q4, but that's before any potential stock option benefits, which can be unpredictable.
Right. Okay, let's look at the balance sheet and cash flow side. How are they managing their capital?
Still generating strong cash. Free cash flow was $423 million this quarter, just a little bit down from $434 million last year, but still very solid.
And using that cash, share buybacks, still a priority.
Absolutely. They bought back $250 million worth of stock this quarter.
Okay.
And their leverage ratio, debt to EBITDA, is sitting comfortably at 2.5 times. So, balance sheet looks healthy.
What about inventory? Often a key metric here.
Inventory per store, up 6.7%. Total inventory up 10.8%.
Why the increase? Just new stores?
New stores are part of it, yeah. But also deliberately investing in inventory for those growth plans. Wider assortments for commercial, stocking up the international markets, filling those new hubs and mega hubs.
Makes sense. You need the parts to sell the parts.
Yeah, exactly. But what's interesting is their net inventory per store, that's inventory minus what they owe suppliers, Accounts payable, that's still negative.
Meaning
They have great payable leverage. They're effectively using supplier financing. Their accounts payable is actually 115.6% of their gross inventory value. That's really efficient working capital management.
that is pretty slick. And the buybacks, you said $250 million this quarter. How much authorization do they have left?
Still got $1.1 billion left under the current plan. And they threw out a stat. Since they started buybacks way back in 1998, they've repurchased more than 100% of the shares that were originally outstanding then.
Wow. Okay, so let's grit and pull all this together. We've gone through sales, profits, spending, balance sheet. What's the bigger picture here? What does this deep dive really tell us, especially for you, the listener, following AutoZone?
Well, first, I think it confirms the auto parts market is still pretty resilient.
Wow.
The backdrop is favorable. Cars are getting older. Buying new or even used is still tough for a lot of folks.
Right, the macro tailwinds are still there.
Yeah, and that provides a solid base, especially for that DIY segment, which, like we said, showed some surprising strength this quarter. And we saw how weather can play a role helping DIY in some areas, maybe delaying the commercial impact a bit.
And management's outlook for Q4 sounded pretty positive, right? Expecting solid trends to continue.
They did. They pointed to slightly easier comparisons versus last year and just continued momentum from all these initiatives they've been investing in.
And those investments are serious. You mentioned the capital spending.
Yeah, about $1.3 billion expected this fiscal year alone. That's a lot of money going into accelerating store growth, especially hubs and mega hubs, getting those 2 new distribution centers fully up and running, and tech upgrades for customer service and supply chain.
So the spending continues.
It does, and the SG&A investments we talked about. Also targeted squarely at gaining share now, making the customer experience better, faster service, better internal productivity. It's a focused push.
And they seem to think it's working now.
That was the clear message. They explicitly linked this quarter's better domestic sales, the commercial acceleration, the DIY traffic turning positive. They linked that directly to these big multi-quarter initiatives finally starting to gain real traction.
Things like the mega hubs, better parts availability, faster delivery.
Exactly. They feel it's starting to pay off visibly now.
And they also expect some of those cost headwinds we saw, like shrink and the DC ramp-up costs, to ease off in Q4.
Yeah, they suggested those should largely lessen next quarter. And they also hope that improvements in merchandise margins will help offset some of that drag from selling more lower margin commercial parts.
What about competition? Do they mention that?
Briefly, they noted some competitors are closing stores or consolidating, and AutoZone feels they're gaining share broadly, not just picking up scraps in those specific markets where stores closed.
Okay, so the overall sense is heavy investment phase, starting to see sales results, expecting cost pressures to moderate, positioning for longer-term share gains.
That sums it up pretty well. It feels like they're in the thick of an investment cycle that's beginning to yield tangible top-line results, with the hope that profitability follows as things mature.
Okay, now before we finish, we have to do our usual disclaimer here. Very important. The next bit is purely for entertainment, just thinking about possibilities based only on what we heard in this earnings call transcript.
Yes, absolutely not financial advice. Investing has risks. Please do your own homework. Talk to a pro. This is just us kicking around an idea based on the call data.
Right. Definitely not advice. Okay, with that massive asterisk, here's a potential trade idea. Maybe a bit out there, but grounded only in the call details. How about a paired trade?
Okay, paired trade, long one, short another.
Exactly. You go long AutoZone, buy their stock. But at the same time, you short sell a direct competitor. Specifically one that, based on their public statements or results, seems maybe a bit weaker on the commercial side or less efficient in their supply chain.
Okay, interesting. So the conviction comes entirely from AutoZone's specific performance and commentary in this call, not a general market view.
Correct. The logic, straight from their transcript, is this. AutoZone's big investments in mega hubs, inventory delivery speed, they're saying it's working. That 10.7% commercial growth is the proof point. They explicitly said initiatives are gaining momentum, paying off, taking share.
Right. So the bet, based on the call, is that AutoZone's specific operational execution, especially in commercial, lets them keep outperforming peers.
Precisely. And layer on top that management suggested some of the Q3 cost pressures shrink, DC costs should ease in Q4, plus their confidence in managing potential tariffs.
Okay, so the thinking is sales momentum continues, maybe even gets a bit better with easier comps while some costs back off. That could lead to better earnings leverage, maybe in fiscal 26, that the market isn't fully pricing in yet.
That's the core idea.
And funding this by shorting a competitor who, again, based only on their public info, isn't showing that same commercial strength or execution.
Exactly. The short acts as a bit of a hedge against the whole sector or maybe facing headwinds, while the long AZO position tries to capture the alpha, the outperformance from their specific transcript-supported story, their operational strength, the investment cycle maturing.
Which management seemed to imply should lead to profit leverage later on.
Right. Outrageous. Maybe a little. Plausible, based only on this specific call transcript. Well, the data points are there. The commercial acceleration, the commentary on initiatives paying off, the expected cost moderation. It builds a narrative, at least.
Okay, but again, just an idea for discussion, entertainment only.
Absolutely, 100%. So let's wrap up this deep dive on AutoZone Q3. Key takeaways.
Strong top-line momentum, I'd say, especially that domestic commercial business. It really seems fueled by those strategic investments that management believes are now showing real traction.
But near-term profits did feel the squeeze from currency headwinds and just the cost of those investments.
Right. But the company sounds confident that these initiatives are driving long-term share gains, and they expect some of those cost pressures, the specific ones like shrink and DC ramp-up, to ease off soon.
It definitely leaves you thinking about the long game, doesn't it? How this big investment cycle might really reshape things in the auto parts world.
Yeah, it makes you wonder if this is just the start of seeing the payoff from those investments, as they seem to imply.
What does that mean for the next few years if this acceleration keeps up? Who really comes out on top in this market?
Exactly. Something for you, the listener, to think about as you watch AutoZone going forward.